Hi, this is Bob Iaccino, Chief Market Strategist and Head of Research at TrendyTrade.com. This week the data isn't going to matter as much this week. We got the granddaddy of data on Friday, the U.S. non-farm payrolls report, and it came in fairly hot. Now, if I would have seen this number 10 years ago, I wouldn't have said that that was such a strong number, but given the backdrop of the kind of labor figures we've had since the economic crisis, this was a pretty strong number. You got a slight beat in the hourly earnings, you got a slight beat in the jobs number, 209 versus 180. The year-over-year work week was only up 2.5%, which is steady, and that's good, but not great. The Fed really wants to see that rise. You really want to see it rise overall in order for the Fed to continue with the plans that they have for the balance sheet and rates. But overall, we can call that a fairly strong jobs report. The market is still playing off that and is going to play off of that. Interestingly enough, from the commodity standpoint, we've got an OPEC meeting in Abu Dhabi where OPEC and non-OPEC members are meeting to discuss the idea of why their compliance dropped off from 108% of the promised production cut down to the low 70s now. So they're going to be discussing that, and you could see some data come out or some headlines come out about that. And that would be a good time for crude oil bulls for that data to come out, because when you look at a macro picture of crude oil, you're really seeing a downtrend. The 51.43 high that we got last week was just a lower high when you back up and look at a weekly chart. So you really need to see crude oil get above 52 to think maybe there's a pause in that trend or even a reversal of that trend into the up move that OPEC wants to see. Currencies, euros pulled back on Friday. The dollar index rallied. The dollar rallied really against everything with that jobs report and stays a little bit strong today. But the euro dollar had broken out to the upside of a horizontal channel and was due for a pullback. Again, this is a more longer term view. The dollar had not broken down when you look at the dollar index representative of the dollar. It had not broken down through its channel yet. So in order for the dollar to do that, you're going to see a little bit of a pullback in the euro, but that's probably a pullback to buy, because while labor has been strong in the US, the other data is not really cooperating. Some details of Brexit are coming out. The UK has put a cap of 36 billion pounds, so about 54 billion US dollars in terms of the divorce payment that they're willing to pay. As these details come out, you could see further deterioration of the sterling US dollar, at least down to 129.30, and there's price action scenarios that longer term could put it at about 120, 150 if that acceleration continues, and dollar yen is still fairly sideways. Now, back to equity markets. Now that 84% of the S&P has reported, we have 72% of the companies that have reported actual earnings beating on EPS and 70% beating on revenue. Those are good numbers. Those are both above the 5-year and 10-year averages for those two metrics. And the blended earnings growth rate is at 10.1%. So if it stays here, double-digit earnings growth rate would be a very positive sign for the future of the U.S. equity markets. However, it's the Dow that keeps making new highs. The NASDAQ and the S&P have not done that. Tesla going to issue $1.5 billion more in debt, bringing their total debt load to $9.6 billion. For perspective, that would have been 10% of the entire auto bailout, more than 10%. The auto bailout was somewhere in the range of $81 billion back in 2009. So that's what we're looking at this week. Some interesting stuff at play. This is Bob Iaccino from TrendyTrade.com, TrendyTrade Pro, and coming soon, TrendyTrade Hedge.